We're going to first look at 11-2B, cash payback period, net present value method and analysis for a service company. So the Social Circle Publications, Inc. is considering 2 new magazine projects. The estimated net cash flows from each project are as follows: the Sound Seller and the Pro Gamer. Each product requires an investment of $125,000 and a rate of 10% has been selected for the net present value analysis. So step 1, we're going to complete a cashback period, and step B, we're going to complete the net present value. Okay, so I've created a table for your cashback period to calculate our cashback period, and what we're going to do with this is here at the top, we're going to do the left side, it's going to be the Sound Seller. And the right side is going to say Pro Gamer. Okay. So obviously we're going to start on year 1. In year 1, net cash flows for Sound Seller, our textbook tells us, was $65,000, and it was $70,000 for Pro Gamer. So $65,000 for Sound Seller and $70,000 for Pro Gamer. Okay. Now our cumulative net cash flow is just where we're going to keep adding these until we get to that $125,000 that we're looking for. So since this is year 1, that's all we have. Okay. So now we haven't hit the $125,000 that we've invested yet. So we're going to stick in here year 2. And I'm just pulling this number out of my textbook, is $60,000 for Sound Seller and $55,000 for Pro Gamer. Now cumulative, so we're going to add these 2 numbers together and we get $125,000. And if we add these 2 numbers together, we get the same $125,000. Our textbook told us that each product requires an investment of $125,000, and that's where we're at right here. So our cashback period is 2 years. So we'll make our investment back in 2 years. Okay. So we're going to go ahead and move on to Part B. In Part B, we're creating a net present value analysis. And again, I've created a table to kind of make your life a little easier. So we're going to start with, if we look at our data, it tells us that we're looking at 5 years. Okay, so we're going to go ahead and fill in our year column. Then our next column says, what is the present value of $1 at 10%? Well, we have a table in our book, and I've put this table in your resources too. And if we look at that table, let's see if I can find it. Is Exhibit 2, there it is. So we're going to use this table, present value of $1 at compound interest, and we had 10%. So we're going to focus right here on this column. So I'm going to take the first 5 numbers out of this column and write them on my paper. Okay. So the first one is 0.909. 0.826. Okay, year 3 was 0.751, 0.683, and 0.682. Oops, nope, 0.621. Sorry about that. Okay, so we're going to list our net cash flow first. So our first magazine is called Sound Seller, and our second one is Pro Gamer. Okay, now our net cash flow is exactly what our textbook gives us. So we're just going to take this data and move it onto our worksheet. Okay. Once I have them all written down, I'm going to add them together. And I get a total of 220,000 for this column and a total of 220,000 for this column. Okay, which is what I should get. The next thing we're going to do is we're going to find the we're going to find the present value of the net cash flow. So again, my first company is called Sound Seller. My second one is Pro Gamer. Okay. So I'm going to take this 65,000 times 0.909. Okay. And when I do that, I'm going to get 59,085. And I'm going to do the same thing for Pro Gamer. 70,000 times 0.909. And I get 63,630. Okay. Let me write that down here. So I took the 65,000 times 0.909, which is where I got the 59,085 from. And again, I did the same thing for Pro Gamer. Okay. Now I'm going to go through and do that for every one of these. I'm going to take the number here and multiply it by the present value. I'm going to take the net cash flow here, multiply it by the present value, and then fill in the answers on the right. Okay, so again, I just took these numbers, multiplied it by the present value, and stuck the answer over there. Oh, I forgot my line right here when I added those. Now, I'm going to do the same thing to these two columns, so I'm going to extend that line straight out there. Keep breaking my lead. And I'm going to add this column, and I get 172,440. And I'm going to add this column, and I get 174,465. Okay. The next row says amount to be invested, and our textbook told us it was 125,000 for both. We're going to put these in parentheses because we're going to subtract them. And when I take 172,440 minus the 125, I get 47,440. And when I subtract these two, I get 49,465. Okay. So since both of those numbers turned out to be positive, either one of these magazines would be a good bet for our company. Okay. If we look at the differential between them, you're talking about $2,000 difference. Okay, so either magazine would be a good fit for our company because they both turned out to be positive numbers. So both magazines are going to help make us a profit. And again, you're looking at differential of about $2,000. So it kind of depends on which customer you want to market to. You know, your Sound Seller is probably more musical, Pro Gamer more video game. Which direction do you want your company to go from here? Okay, at this point you can go ahead and work on your assignments. Have a great week.